So Invesco Mortgage Capital just dropped its second quarter numbers, and it was a turbulent quarter to say the least. Today, we're going to break down those numbers, figure out what management's defensive strategy is all about, and give you our final call on where we think the stock is headed.
Okay, let's just dive right in. The second quarter was a total roller coaster, not just for IVR, but for the whole mortgage REIT sector. We saw some really intense market volatility, and for Invesco Mortgage Capital, that put some serious pressure on its book value. It really forced management's hand and made them pivot to a much more defensive game plan. So, what did the results actually look like? Well, honestly, it's a bit of a mixed bag. The headline numbers tell this story of contradictions. You've got a GAAP loss on one side, but then a pretty solid beat on the core earnings metric that, income investors are watching like a hawk.
Now, if you're just looking at the surface, the numbers might look a little rough. A GAAP loss of 40 cents, a miss on revenue, not great. But the number that really truly matters for a mortgage REIT is earnings available for distribution, or EAD. And on that front, IVR actually beat expectations, coming in at 58 cents per share. Why does that matter? Because that EAD is the actual cash flow they use to pay out that dividend.
And this is a big but, that positive earnings number was pretty much overshadowed by the pressure on their balance sheet. Book value per share, which is basically the company's net asset value, it took a 76-cent hit. It fell down to $8.05. This is really where you can see that market volatility left its mark.
So what does that all mean for you, the investor? Well, when you add the dividend to that drop in book value, the total economic return for the quarter was a negative 4.8%. To put it simply, the loss in the value of their assets was bigger than the dividend check you got in the mail.
Okay, but let's circle back to that core earnings power, because this is absolutely crucial. That 58 cents per share in earnings available for distribution, it easily covered their 34-cent dividend. And that's a key takeaway here. It shows that even with all these paper losses hitting book value, the company's underlying portfolio is still cranking out enough real income to keep paying shareholders.
So what on earth caused this huge disconnect between the earnings and the book value? Well, the answer really lies in the wild market swings we saw during the quarter, which kind of played out in two different acts.
You really have to think of this quarter as a tale of two halves. It kicked off in early April with this major shock to the system, all driven by new tariff talk. That sent interest rate volatility through the roof and caused agency mortgage-backed securities to just sell off hard. But then, a 90-day pause on those tariffs was announced, and things started to calm down through May and June, letting the market catch its breath a bit.
And you don't have to take my word for it. On the earnings call, CEO John Ellen basically confirmed this. He described it as a market shock that wasn't just some minor blip, but a broad repricing of risk that they had to deal with on the fly.
So, when you're faced with that kind of environment, you can't just sit on your hands, right? Management didn't. They immediately shifted gears and went straight to their defensive playbook. Let's break down exactly what moves they made to try and weather this storm.
Their biggest and most direct action was to pull back on risk by reducing leverage. They took their debt-to-equity ratio down from 7.1 all the way to 6.5 times. This was a super clear signal that, in a crazy market like this, their number one priority was preserving capital, even if that meant giving up some potential upside.
And this was a full-on defensive strategy, not just one move. They didn't just cut leverage. They also sold off some riskier assets and got out of those generic mortgage futures, the ones we call TBAs, and moved into more specific assets with more predictable performance. And to top it all off, they cranked up their hedge ratio to 94% to protect themselves from any more wild swings in interest rates.
And you might be wondering, well, won't lower leverage hurt returns? The Chief Investment Officer, Brian Norris, addressed that head-on. He made it really clear why they're comfortable with this defensive posture. He basically said that even with less leverage, the portfolio's income is strong enough to cover the dividend. In his eyes, there's just no need to pile on more risk right now.
So, what about the road ahead? Well, it looks like caution is still the word of the day. Management's guidance suggests they're still pretty wary of what might happen in the near term, but they're starting to feel a bit more positive about the longer-term setup for their main assets. Looking forward, there are a few key things that are going to really dictate IVR's performance. The big one, of course, is the Fed, if and when those rate cuts actually happen. Also really important are swap spreads. If those tighten up, it could actually hurt the performance of their hedges. And finally, the whole sector's waiting for commercial banks to start buying mortgage securities again. That would be a huge tailwind for everybody.
Now, they did offer us a little green shoot of optimism.
Management mentioned that as the market started to stabilize a bit in July, they estimated that their book value had already bounced back by a little more than 1% since the quarter ended. It's a positive sign for sure, but the recovery is definitely still in its early days.
So let's put it all together. How should you, as an investor, be thinking about this stock right now? It really comes down to weighing the company's defensive moves and that solid dividend against these macro headwinds that just won't seem to go away. And here's the core debate for IVR stock. The bull case is pretty straightforward. It's all about that attractive dividend, which looks very well covered. Plus, you have the potential boost from future Fed rate cuts and those early signs of a book value recovery. The bear case, on the other hand, points to all this macro uncertainty, the risk that their hedges could underperform, and the simple fact that the stock has been lagging its peers.
All right, so taking all of that into account, here's where we land. We're initiating our coverage with a market perform rating. That strong dividend yield, it provides a really solid floor for the stock's valuation. But the ongoing macro uncertainty and those specific risks around their hedge book, they're probably going to cap any major upside in the near term. It's really a classic case of getting paid to wait, but there isn't a clear catalyst that's going to make this stock suddenly re-rate higher. The big question for you is, are you willing to collect that dividend while you wait for this macro storm to finally pass?
And as always, just a quick reminder, this analysis is for informational purposes only. It should definitely not be considered investment advice. Please always do your own research before making any financial decisions.